Hello and welcome along to another Taking the Biz revision tutorial. If you're new to the channel, definitely think about subscribing, and in this video we're going to investigate the business ownership topic of partnerships. Now, a partnership is a business that is owned by 2 or more people, and typically that will be 2 to 20 partners that own a business together. Partnerships, like sole traders, are what we call unincorporated businesses, which means they have not been through a process known as the incorporation process to formally register the business with the government as a separate legal identity to the owners. More on that in a moment. So in examinations, it's very common for us to get quizzed on the potential benefits and limitations of running this model of business compared to other types of ownership. So if we start with the benefits, then compared to starting your business as a sole trader, one big benefit of starting a partnership is that you have more than one owner. And more than one owner means that more than one person is going to be contributing startup capital to the organization. So rather than one person potentially investing £5,000 that they have saved to run a business, you might have 2 or 3 or more people who are all able to contribute similar amounts, which may mean the business can start up on a slightly larger scale than if it was to just be one of those people by themselves. So it may mean that the business can perhaps develop more products from an early stage. Maybe the business can target a wider geographic market from an early stage, or maybe it can achieve higher levels of quality or use better raw materials than if just one owner was to be starting this business as a sole traders. Now, as well as each of these owners or partners being able to contribute capital to the organization, of course, they're all going to bring their own skills to the partnership as well. And that might be particularly useful if each partner is able to contribute something different. So one of those partners might come from a finance background, but be weak at marketing. And as sole traders, that would be a deficiency for the organization. But with a partnership, they might have another partner in the organization that comes from that marketing background. Another partner might come from an operations background, and they can each specialize in their own areas of expertise to help the business thrive in more different areas. It may also be that people within the partnership might have different practical skills. So if the partnership is perhaps a construction business, one might specialize in the plumbing part of the business, whilst another specializes in the electricians, another specializes in the building. So each partner can bring different areas of skill sets or expertise to the organization, which theoretically may allow a better service to be provided for customers. We've also got the benefit of multiple partners being able to share the pressure or the responsibility of running the organization, being able to cover for each other during periods of illness or holiday or other absences. And we've also got the idea that just like sole traders, partnerships have less bureaucracy attached to them than limited companies have. There's less registration processes to go through. There are easier and quicker tax implications. There's less reporting to the government of financial issues, and also any financial documentation is kept private within the organization, whereas with limited businesses, they have to make their accounting information available to people who may request it. We've also got, just like sole traders, tax issues associated with partnerships as well. So as an unincorporated business, the business does not pay corporation tax at 19% of the first pound's profit earned. Instead, each of the partners is seen as someone who is self-employed, who have the same legal identity as the business that they are running. And so just like a worker who has a job with a wage or a salary, the partners in a partnership pay income tax. And the benefit of that is that those partners have a tax-free allowance of £12,500, meaning that each can earn up to that sum before they have to start paying tax, which may mean if the partnership is not turning over huge sums of profit, that each partner can benefit financially, whilst profits are smaller, from paying income tax rather than corporation tax. Now, the first limitation of running your business as a partnership is one that's shared with those sole traders. So it's really a limitation compared to some of the larger forms of ownership, such as private limited companies. And that is that the owners in a partnership all have unlimited liability. So in the event of bankruptcy, or in the event that the business gets sued, if the business's own assets are insufficient to cover the debts of the organization, the partners have to cover those debts, even if that means that they have to fund the business's debts through the sale of their own personal assets. So partners may risk losing property that they own or vehicles that are sat on their driveways. These assets that are personal to the partners can be seized and used to pay off the debts of the business that they are running. And that's because in the eyes of the law, the business and the partners are the same legal entity. So the debts of the business are the debts of the partners, and that can be a lot of pressure and a burden for some people. If we compare partnerships to sole traders, we've also got the limitation that now that we have more than one owner, we have to split any profits the business makes more than one way. We've also got the potential that we've now got more voices at the table trying to contribute to decision making. So there's the potential in partnerships for there to be conflict, dissenting voices, different partners having different visions and strategies that they would like to pursue. Now, obviously, this gives rise to the potential for disagreements and for conflict between partnerships, possibly heated conflict. Now, why is this a problem? Well, whilst the business is embroiled in conflict, the business isn't moving forward. Decisions are not being made. Strategies are not being deployed whilst the owners are debating what those strategies should be. In a sole trader, once the owner is happy with the strategy that they would like to pursue, they can deploy it. But in a partnership, there may be disagreements en route to agreeing that strategy that may slow down decision making. Now, in order to try and combat this very limitation, many partnerships might draw up a document at the outset of their business venture known as a deed of partnership. And a deed of partnership is a document that essentially lays out a framework or a rule book for the partnership and how it's going to operate. So in the event of any disputes such as how profit should be shared or how losses should be divided, or any disputes on decision making or any disputes on control, they can refer back to the deed of partnership. And in extreme cases, when conflict in partnerships means that legal routes are taken to try and assert one partner's views over another, judges can refer to this deed of partnership in order to try and settle the disputes in the organization. Now, one final thing we'll make sure that you're aware of for partnerships is that although the partners have unlimited liability, in some rare cases, there are partnerships that have applied for what's known as limited liability partnership status. And what that means is that while some partners will continue to have unlimited liability, when the organization applies for limited liability partnership status, they are granted permission to take on some partners who will have the protection of a limited liability. And these partners are what are known as silent or sleeping partners. And you have limited liability as a partner in an organization if you are a sleeping partner, which means that you contribute capital to the organization of the partnership and you draw profit from the partnership, but you're not actively involved in the day-to-day running of the business. So essentially you're an investor in the partnership without being one of the integral figures in the partnership. Now, because you are a more withdrawn role from the partnership and you're just risking capital to try and make a return, you are allowed limited liability in this scenario to make it more attractive for investors to fund partnership organizations. So limited liability partnerships are a rarer form of partnerships, but one that you should still be aware of in your exam. But some of those partners will still have unlimited liability. So it will just mean that any losses or debts of the business are shared amongst the partners with unlimited liability. Partnerships is a very common topic on A-level exams. We need to be able to contrast them to smaller organizations like sole traders and larger incorporated businesses like private limited companies as a way of distinguishing what the advantages and limitations are. Hopefully that video will help you revise. We'll see you soon for some more tutorials. You keep on taking the biz.